All right, so we're going to be doing some more tax problems. We're going to be talking about timing differences and permanent differences and changing of tax rates and also net operating losses. So let's have a look. Here's the problem. Woody had taxable income of $8,000. Now notice that taxable income is not income before taxes, so they're actually giving us that bottom number there instead of the top number. They're telling us that the maker's depreciation, that's the tax calculation, what the IRS requires, is $3,000, while the depreciation in the income statement, that's GAAP, was $1,000. So there's a $2,000 increase in the amount of depreciation allowed on the tax return than there was in GAAP. If there were no other differences, what's pre-tax accounting income? So they actually want you to back into the beginning number. So let's populate this analysis here. So taxable income is $8,000 at the bottom, and then we would actually have to add that $2,000 back because the pre-tax income, we would subtract that $2,000 to get to what would be taxed because it's sheltering an additional $2,000 of income by the excess of tax depreciation over book depreciation. And so here's the math. That income before taxes must have been $10,000, and then you subtracted an additional $2,000 of depreciation allowed for taxes that were not allowed for GAAP to get down to what you're actually going to have to put on the tax return and write a check for. So here's the journal entry for this. They didn't ask, but let's go ahead and do this as a way to start working our tax muscles. The income taxes payable is always taxable income times the current year rate. Here we're only given one rate, so the current and future rates are the same. We have a liability. We're eventually going to have to pay taxes on that full $10,000. We don't have to pay it all now because we have some depreciation that's sheltering that. But eventually that's going to turn around where the book depreciation is going to be greater than the tax depreciation in the later years of this asset's life. Because it's just a temporary difference. It's not going to be there forever. So we're eventually going to have to pay taxes on that $2,000. So it's put into a deferred tax liability account at the rate we think is going to be true when it turns around. Here we only have one rate, so that would be 30%. And then you add the current and the long-term liabilities to get your tax expense. So you add the $2,400 and the $600, $2,400 and the $600 to get the $3,000. All right, let's try a new one. If you're feeling adventurous, you might freeze the frame here and try it, and then walk through it with me. Okay, so here they give you pre-tax accounting income, so that is the top number. And they give you a tax rate. There's only one tax rate, so the current and future tax rates are the same. Now, the temporary difference is that rent was received on the last day of the year, so the cash came in, but it was for the following year. So it would be prepaid rent for GAAP. But the tax IRS rules are that it is taxed when you get the cash. So what would we have to do? It's not a permanent difference, it's temporary. But we would actually have to add that $15 million in and let it get taxed according to the tax law, even though it's not shown as rent. It's unearned rent actually in GAAP. It stays in unearned rent. It doesn't come into rent revenue until the following year when it's considered earned. So let's do the journal entry for this one. What would it look like? We'd have taxable income times the current year rate. And now we have a deferred tax asset. Why is that? Because we're going to pay taxes on that rent received before it's recognized for GAAP. And so it works a little bit like a prepaid tax. And so that $15 million times the tax rate would go into a deferred tax asset. And then next year when the income comes through, you'll back it out because you've already paid taxes on that. And that will clear out the deferred tax asset. And then the income tax expense is the net of those two because you have a liability and asset. And so the expense is the net of the two. So there is often when you're learning the accounting for taxes, there's often some confusion about, is it a deferred tax asset, deferred tax liability? And you don't net the two, by the way. Each individual issue is separately accounted for. So you noticed we had a deferred tax asset here. If there was also a depreciation entry, we wouldn't net them. You could have both a deferred tax asset and a deferred tax liability in this journal entry. So the rule is in the year that the difference originates, so when it starts, when you buy an asset or when you receive the rent in advance or whatever the transaction is, if the timing difference reduces taxable income, you're going to have to pay later and you have a deferred tax liability. If that timing difference in the year it starts increases taxable income, it means you're paying now for something that'll arrive in GAAP later. And so that's prepaid. All right, so you notice here that the $15 million increased taxable income. Let's go back here. Here, the depreciation decreased taxable income. So that can be helpful to you in deciding whether you have a deferred tax asset. And then as it turns around, you're just emptying out the original either asset or liability. Okay, so here's a problem where the current rate and the future rates are not the same. So the current rate is 40%, but next year it'll be 35%, and then the year after that and all subsequent years is 30%. So if you want to try it, go ahead and freeze the frame and then walk through it with us. So the first thing we do is go ahead and populate our analysis here for calculating taxable income. So we start with the $500 million pre-tax accounting income that they give us. There's no permanent differences here. And then we subtract out the excess depreciation here. And we get down to taxable income. So taxable income is going to be at the 40%, but that $60 million, $20 million is going to be next year, $20 million is going to be the year after that, and $20 million is going to reverse the year after that. So you have $20 million reversing at the 35% and the other $40 million reversing at the 30%. So let's do the journal entry for that. So the income taxes payable, the taxable income times the current rate is just the current rate, just ignores the future. And then that $60,000 is going to be split into the 20 that's next year, which will be 35%, and the 40 that's the second and third year of the 3-year turnaround. So you book the liability at the rate you think you're going to be paying, the future enacted rate, not the rate you think Congress might enact into law, but the only laws that are actually already passed. Then you get income tax expense by the net, whatever it takes to balance the entry. In this case, adding the 176 and the 19. So let's change the topic a little bit and let's talk about net operating losses. Here we have a company that was profitable until 2014, then they had a big loss. Then they were profitable again and they had another big loss. And there's various tax rates there. They tell you that the losses in 14 and 16 were the result of a restructuring and future years are expected to be profitable. That's important because if you have losses and you set up a deferred tax asset, which we're getting ready to do, you can't leave that asset on the books if you don't think you'll be able to generate profits in the future and use that asset. So we would actually have to reduce the value of that asset with a contra account to get it down to what we think we could use. But here, the losses are because of one-time events, and the core business is actually profitable. So we know we can book a deferred tax asset without having to do a valuation adjustment. Okay, all the rates were enacted in the year and not known in the prior years. So when you're standing in 2014, you don't know about the 45% or the 50% that's coming up. Those tax laws were enacted in 2015. So when you're in 2014, you don't know about it yet. Okay. And so what is the journal entry to record the losses in 14, 15, and 16? Or the loss in 14, the profit in 15, and the loss in 16. So the rule is you can carry back 2 years, or you can carry forward, I think, up to 20. You don't have to carry back, but if you do carry back, you can't carry back just to prior year. You actually have to go back 2 years. So here the losses in 2014, we can't go back to 2011. Even if you wanted to, that's 3 years ago. So that's not available to you. And you can't go back to just 13. You have to go back to 12 and wipe out that 15 and then wipe out the 20 that's in 13. So you could get a credit or a refund for $35,000 of the $100,000 right now. But it is at the rate you paid in the prior year. So you can't get that $35,000 at the 40% rate, which is the current enacted rate. It is the rate that was enacted in the year that you paid the tax. So that $5,250 and the $7,000, you can get that refunded to you right now. And then the rest of the $100,000 minus 35, the $65,000 is a deferred tax asset at the current rate or whatever rate you expect. And right now we don't know of any different rate. We'll book that as a deferred tax asset. So what will that look like? Let's write that out. We'd have an income tax receivable for the $5,250 and $7,000 that soaks up $35,000 of the $100,000, leaving us with $65,000 at the 40%. So that $26,000 is the $65,000 at the 40%. And then those two added up is a credit to tax expense. And when we credit tax expense, we often rename it and call it tax benefit. But that's basically a credit to the income tax expense account in the chart of accounts. Okay, so now let's talk about 2015. You made money. You had made $50,000 in taxable, or you have $50,000 in taxable income. We're not sure how much GAAP profit you made. So that can soak up some of your net operating loss carry forward. You had $65,000 net operating loss carry forward. You used $50,000 of that, so that leaves $15,000 at the 45%. So the accounting for income taxes tells you to get the balance sheet right, and then the income statement is the plug to get the balance sheet right. So the balance sheet that we need at the end of 2015 is that $15,000 carry forward at the new rate of 45%. So that's, we target that ending $6,750 and say, okay, we had $26,000 at the beginning of the year. We need $6,750 at the end of the year. The difference is the credit we need in the journal entry. So we'll be debiting tax expense and crediting the asset to get it down to what we need. So that will be the amount of the tax expense for 2015 is whatever's needed to get the deferred tax asset to the new level. So let's do 2016. We still have the $15,000 carry forward, but we also now have a new loss. So we have $215,000 carry forward at a new rate of 50%. So that means that we need a deferred tax asset balance of the $215,000 times 50% or $107,500. We have a deferred tax asset balance at the beginning of the year of $6,750. And so the journal entry is what's needed to get to the new balance, the difference between those two. So we would debit the deferred tax asset for that amount and credit tax benefit. That's the income tax expense account, which we call tax benefit if you're crediting it. Now they say, what happens if in 2017 there's a change in the tax enacted rate? So they're not giving us any new profits for the year. The year may not be over yet, but Congress has passed a tax law. What entry would you have to make? And so now we have to refigure what the asset should be. So we still have $215,000 in net operating loss carry forwards, but we have a new rate, 40%. So now the deferred tax asset should be $86,000, and so we would have to make an entry, even though there's no new profits yet, because 2017 is still in play. We would still have to make a journal entry to revalue that tax asset at the new rate. So we would actually have to debit tax expense and credit deferred tax asset for the change in the tax rate. And this is actually a fairly current event. The Wall Street Journal just had an article, 2 articles. The first one, there were several of them, I just picked 2. BP takes a $1.5 billion charge related to U.S. tax overhaul. The oil giant must revalue some tax assets under the new legislation. So they tell you that the tax changes changed the value of its deferred tax assets. That's right. So they had some net operating loss carryforwards apparently, and so the value of those assets has gone down because the tax rate dropped from 35% to 21%. So they had to do a journal entry even though it's only January 2nd and 2018 hasn't, the profits for that year haven't even been happened. The transactions for 2018 haven't even happened, right? It's only January 2nd. It's only the first day of the year. But they still have to go, they have a tax expense on the very first day of the year of a massive amount. And so that journal entry would look like the journal entry we just did here for the change in enacted rate. 2 weeks later, GM took a $7 billion write-off. It probably took them 2 weeks to figure out the amount of the write-down because of the complexity of their tax accounting, no doubt. But they say the same thing, that the value of the credits against future taxes. So instead of using the word tax assets, they talk about credits against future taxes. So they have net operating losses, but the value of those loss carryforwards was reduced from 35% to 21%. And so they had large write-downs of the tax assets. All right, dig in, practice, learn.